Imagine walking into a casino, laying $175 billion on the roulette table, and the pit boss taps your shoulder to tell you your credit is no good.
Ouch. Yeah, not ideal.
I mean, that is exactly what just happened to big tech. It's Sunday morning, the market is closed, and we're looking at last week's close, which locked in a brutally defensive shift. Friday basically cemented a bearish distribution week across the major indices.
Completely.
We saw the S&P 500 take a 1.6% weekly loss. It closed at 7,457.69, which means it broke right below its short-term tactical pivot of 7,500.
Right, but the real blood in the street, I mean, that was in tech.
Oh, absolute carnage. The Nasdaq 100 took a brutal 4.0% hit, closing at 28,592.66 and just slicing cleanly through its 50-day moving average.
Yeah, the technical damage on the surface is severe. If you zoom out and look at the weekly time frame, those hyperextended trades, specifically the AI and semiconductor momentum plays, they finally snapped.
They really did.
And you mentioned the Nasdaq, but look at the underlying engine. The Philadelphia Semiconductor Index, the SOX, it plunged 20% from its June peak.
Wow, 20%.
Yeah, so officially, by definition, semiconductors have entered a bear market. The elasticity on that trade didn't just bend, it completely broke.
Okay, let's unpack this, because I do want to push back a bit on the panic narrative here. Yes, the cap-weighted indices bled out, but if you look under the hood at the volume profile data, Friday saw a massive $8.25 billion market on close buy imbalance.
Right, the MOC data.
Exactly. For the active trader listening, that basically means a gigantic flood of blind buy orders hit at the literal last second of the day. And on top of that, the equal weight S&P 500, the RSP, actually closed up 1%.
That's a huge divergence.
Right. So zooming out, is this a systemic collapse we're watching, or are we just seeing smart money execute a violent unhedged rotation out of momentum and into energy and value?
Well, don't confuse a rotation with a complete absence of risk. The data is pointing to a harsh valuation reset. It's not a total liquidation, but the smart money is heavily arming themselves on their way to the new table.
What do you mean by arming themselves?
Take a look at Friday's CFTC Commitment of Traders report. Large speculators are net short 38.9K contracts on the S&P 500.
Wait, almost 39,000 contracts short?
Yep, 38.9K. They're aggressively shorting the broader index to hedge against their tech exposure, even as that underlying market breadth technically improves. So it's a tale of two markets, sure, but the defensive posturing is just undeniable.
Which brings us to the single biggest macro theme driving the market right now, which is the CapEx Reality Check.
The AI honeymoon is over.
Officially did.
Yeah.
The era of AI spend at any cost is gone. The narrative pivot last week was undeniable, and we had three specific catalysts at the close that drove this home. First, TSMC hiked their 2026 CapEx guidance to between $60 and $64 billion.
Massive numbers.
Right. And a year ago, the market would have thrown a parade for that, proof of infinite AI demand.
Oh, absolutely. The stock would have soared.
But on Friday, it sparked immediate panic over profit margins.
Because the institutional framing has violently shifted. When capital was cheap, and the AI narrative was fresh, massive expenditures were treated as an automatic multiple expansion cheat code.
Yeah, just spend money to make the stock go up.
Exactly. But now, institutions look at these multi-billion-dollar build-outs and view them strictly as margin drags. They see severe cash flow risks. We're officially pricing in AI CapEx fatigue.
AI CapEx fatigue.
Yeah. The fear is that these mega caps are overbuilding capacity for a software monetization cycle that is still years away from turning a profit.
And it isn't just the cost of the build-out driving this fatigue, right? The technology itself might be shifting beneath their feet. You pair that TSMC CapEx number with the second catalyst, China's Moonshot AI, releasing their low-cost Kimi K3 model.
That is a massive paradigm shift.
It really is. It proves that advanced AI might require significantly less compute power, which means far fewer high-end chips to operate effectively.
And that's the mechanism nobody is talking about enough.
Yeah.
I mean, if the software models become highly efficient, the massive hardware moat that companies like NVIDIA and TSMC have built starts to look incredibly vulnerable.
They don't need as many chips.
Exactly. The market is projecting hardware saturation. And honestly, that explains why Netflix slumped 7% post-earnings, even with decent numbers. We have transitioned into a strict sell-the-news regime.
Future promises just don't cut it anymore.
No. Wall Street wants to see the cash right now.
So let's apply that exact dynamic to tomorrow morning. We have the mega cap tech earnings season kickoff happening this Wednesday, July 22nd. And the stakes are astronomically high.
Very high.
You've got Alphabet needing to justify a $175 billion plus 2026 CapEx budget. They're projected to pull in $116.9 billion in Q2 revenue.
Right.
And Wall Street is basically demanding flawless execution and massive cloud growth just to excuse that capital expenditure.
They have to show absolute perfection in their cloud margins. I mean, if they miss by a fraction of a percent, the punishment will be swift. The market is demanding proof of immediate margin-accretive monetization.
And then you have Tesla reporting on Wednesday, too. They beat delivery estimates. They pushed out 480,126 units, but now they have to defend a $25 billion budget specifically for robotaxi and real-world AI infrastructure.
Which is a huge gamble.
Huge. Wall Street used to write blank checks for that futuristic vision, but now the checkbook is completely closed. If the market is penalizing AI spend, Tesla is walking into a remarkably hostile environment.
If they fail to prove the immediate ROI for that $25 billion, the tech unwind from last week is going to broaden out significantly. Institutions are going to systematically de-risk their mega-cap exposure.
So Alphabet and Tesla are the first real tests of this CapEx reality check regime.
Without a doubt.
But that institutional panic over AI spending, it doesn't exist in a vacuum. If these tech giants rely on debt to fund infrastructure, the cost of that debt is suddenly the most important metric in the world.
Always comes back to the bond market.
Always. Which means we need to reset the deck and look at the macro side, specifically the U.S. 10-year yield. On the surface, the domestic pipeline seems quiet. The Fed is in their blackout period ahead of the July 28th FOMC meeting.
Right. Zero Fed speak.
Exactly. But the geopolitical backdrop is an absolute powder keg.
The volatility markets are definitely sniffing that out. The VIX jumped over 12% last week to close near 19.
Yeah, 19 is getting elevated.
It is. But the real story, the one that threatens the entire tech valuation model, is energy.
Brent crude spiked to 88-point den. That was up over 4.6% on Friday alone, driven entirely by U.S.-Iran tensions in the Strait of Hormuz. And through all this, the U.S. 10-year Treasury yield, the U.S. 10Y, is securely holding at 4.55%.
Which is being supported by massive institutional hedging.
Right. Highly sophisticated capital parking in treasuries to hide from equity volatility.
But you have to connect that geopolitical risk directly to domestic monetary policy. A spike in Brent crude to 88.1 brings inflation fears roaring back to the table right at the worst possible moment.
Especially with the new Fed chair.
Exactly. Kevin Warsh has explicitly declared no tolerance for persistent inflation. If energy prices bleed into headline inflation, Warsh will not hesitate to keep rates higher for much longer.
So let's define the stakes on that bond market tension. The U.S. 10Y is at 4.55%. The multi-year psychological ceiling for that yield is 4.60%.
Right.
If oil keeps ripping and the 10-year decisively breaks that 4.60% ceiling, we get a violent bear steepening targeting 5.00%. And for anyone listening who doesn't trade bonds, a bear steepening fundamentally destroys the discount rate used to value long-duration assets.
Which is exactly what mega-cap tech stocks are.
Right.
It pulls liquidity out of everything. If the 10-year target's 5.00%, it violently compresses equity valuations. That rotation we saw last week into equal weight value names, it won't matter.
The cost of capital just becomes prohibitive.
Indiscriminately lower prices across the board.
Which makes this week's red folder events an absolute minefield. Tomorrow morning, Monday, we get the PBoC rate decision, expected at 3.00%, and Canada's CPI, expected at 3.0%.
Pretty standard there.
Yeah, but then we fast forward to Thursday. The ECB rate decision. Markets are pricing in an 84.5% probability that Lagarde holds at 2.25%. But with that energy spike, she could easily get highly hawkish.
Very easily.
We also get U.S. jobless claims Thursday. And then Friday is the main event. Flash PMIs. Manufacturing expected at 55.5, services at 51.5, followed by new home sales expected at 615K.
Thursday's ECB press conference is the massive sleeper risk. European energy markets are so sensitive to supply shocks. If Lagarde warns about energy inflation and leaves a rate hike on the table, it triggers a global sovereign bond rout.
Right, because European yields spike.
Yes, which forces U.S. Treasury yields higher to compete for capital. It tightens U.S. financial conditions without our Fed doing a single thing.
Wow, okay. But I want to push back on the standard playbook for Friday's PMI data. Friday is a total binary risk. If manufacturing prints above 55.5, it proves the economy is running way too hot for rate cuts.
Yield spiked.
Exactly. But here's the critical vulnerability. 97% of the S&P 500 is currently in a corporate buyback blackout window.
So the structural shock absorbers are effectively gone.
Gone. Doesn't that lack of discretionary demand leave the market completely defenseless against a hot PMI print?
It leaves them defenseless against velocity. When 97% of the index is legally restricted from buying their own stock, the market is entirely at the mercy of institutional flows and retail momentum.
Massive air pockets in the order book.
If we get a hot PMI print on Friday confirming demand is too strong, the institutional reaction is to dump equities and short bonds. With no corporate bid catching that knife, the downside velocity could be breathtaking.
So for the active trader listening, we need a tactical game plan. You need specific actionable parameters starting tomorrow morning. The overarching environment right now is a negative gamma regime.
Deep in negative gamma.
Right. And dealers are trapped in it. The absolute line in the sand pivot for the S&P 500 this week is 7,585. Write that down. 7,585.
That's the ultimate dividing line.
Let's look at the downside first. If we break below 7,585, that negative gamma acceleration kicks into high gear. Dealers dump futures, and we have rapid downside targets at 7,532, then 7,470, with major put support acting as a floor at 7,340.
And the upside?
Well, if 7,585 holds, short hedges get covered. That mechanical buying triggers a violent squeeze to 7,610 and 7,645. What about the Nasdaq 100? It's been the epicenter of this carnage.
On the Nasdaq 100, 28,200 is the make-or-break neckline. If you lose 28,200, the bullish macro trend is dead. Do not take your eyes off 28,200.
Got it. So where is the specific sector play this week amidst all this rotation?
The sector in the crosshairs is real estate and home builders. You want to watch the REZ, ITB, and XHB ETFs?
Why them?
The 30-year fixed mortgage is sitting at a very painful 6.49%. Friday is the catalyst. We get PMIs and new home sales. If the PMIs are hot, bond yields rip, and that 30-year pushes to 7%.
And builder margins get annihilated.
They get crushed. But if the data prints cool, bond yields fall, and you'll see a massive relief rally in housing. It's a highly levered play on Friday's data.
So it all comes down to the yields.
Entirely.
All right, wrapping up this deep dive, the key word this week is discipline. Historically, July's bullish seasonal window slams shut around the 23rd, which is Thursday. So don't catch the falling semiconductor knife just yet.
No matter how tempting it looks, respect the negative gamma chop, stick to the 7,585 pivot, and monitor that 10-year.
Exactly. I want to leave you with a final thought as you prep your charts for tomorrow morning. We've talked a lot about U.S. yields and whether equal weight value can prop up the index if Alphabet and Tesla fail to prove their CapEx ROI.
Right.
But consider this. If China's new Kimi K3 model proves that advanced AI can actually be run efficiently on vastly cheaper low-compute infrastructure, maybe the real rotation isn't out of U.S. tech into U.S. value.
What do you mean?
I mean, maybe the smart money is quietly realizing that the massive hardware moat of American mega-cap tech just became entirely obsolete. Just something to mull over before the opening bell. Keep your position sizes small, respect the levels, and we'll see you out there.